Joining me now to unpack all the action is Michael Reinking. He's a senior market strategist for the New York Stock Exchange. Michael, welcome.
Good morning. Yeah, so we haven't quite triggered a bear market just yet. So we're pretty close.
We are
pretty close.
Indeed close. Dramatic drops, in fact, that we saw on Thursday and Friday in the stock market after President Trump provided higher than expected tariffs than what were originally impacted. And in fact, we do know as part of that package, more tariffs are on the way on Wednesday. Walk us through the equity market's response.
Yeah, so I mean, I think there's a couple pieces, right? The tariff announcements were much worse than markets had expected. I think markets were looking for something closer to kind of a 15 to 16% effective tariff rate. We're looking at something that's kind of well north of kind of 20% at this point. So we definitely had a surprise. Markets were kind of largely working under the assumptions that tariffs were going to be this negotiation tool. We continue to hear the administration really kind of point out that this is something that they want to remain in place. It does seem like they're very serious about kind of some of the revenue that's being that will be generated from tariffs. In kind of the calculus of moving forward with their reconciliation process, right? So markets are kind of readjusting to kind of this new normal.
So for our viewers watching, what should their expectations be in the days and weeks ahead, knowing that more duties are on the way on Wednesday?
Yeah, so I mean, I think, well, the first thing that we're becoming very used to is volatility, right? And that was one of the things that we had talked about kind of coming into this year with this administration, right? And we're seeing that kind of very much play out. Now, I think like in the near term, we're going to get a lot of headlines kind of coming from countries around the globe suggesting that they want to kind of have negotiations. We've seen kind of Vietnam offer to lower their U.S. Tariffs on U.S. products to zero. Right, we've just heard from Prime Minister in Japan suggesting he may come to the U.S. and the EC President van der Leyen also kind of had suggested that they're open to negotiations, right? So that's that's going to be a positive as we start to hear those. But markets are going to kind of discount that until we start to get a better sense of what kind of the president ultimately is looking for, because it doesn't seem like the idea of just lowering tariffs to zero is kind of their end game. We heard Peter Navarro this morning kind of start to suggest that they want to see countries take off some of those non-trade barriers, right?
Yeah.
So it's hard to kind of really see markets kind of finding their footing here, in the near term until we have a better sense of what the ultimate outcome is.
So Wednesday also is what we could call the unofficial start to earnings season. Delta's going to report earnings on Wednesday before the bell. Then we'll get the wave of big banks on Friday, right? JP Morgan Chase, among others. How do these companies navigate this environment?
Right, and that's the biggest and hardest question, right? Because as a corporation, you're making investment decisions for many years, right? And there's just so much uncertainty that it's really hard to kind of commit to those decisions in this environment. When you think about kind of the market reaction that we've had, right? Part of what's happening is markets are starting to price in the expectation for a slowdown in growth. Right, and if you kind of think about that, that's going to ultimately impact kind of corporate earnings as well, right? So we were trading at some kind of reasonably elevated multiples coming into this year with pretty high growth expectations. You're going to start to see those kind of come down, right? We started to see investment banks cutting not only GDP estimates, but they're starting to cut kind of the earnings estimates as well. And as we move into this earnings season, I can't see any kind of world where management teams want to be aggressive in any way, shape, or form. Right? I would expect to see there being some guidance cuts, potentially companies even removing kind of guidance and just taking guidance off the table and saying, we can't really look at this environment and figure out where our numbers are going to be. So we're going to just kind of remove guidance at this point.
And how would the market interpret that? Would no guidance maybe be a softer blow than dramatically lower guidance just to plan for the worst?
Right. I think sometimes kind of throwing the baby out with the bathwater and kind of resetting those expectations, lower, right, is the better option, because if you kind of just remove guidance, that introduces a layer of uncertainty, right? So if you try to kind of plan for the worst case scenario and really kind of reset the bar, if things kind of start to play out, kind of in a more positive fashion in the back half of the year, right, you can kind of start to see kind of kind of positive revision cycle, to earnings, which would be kind of really helpful from a market perspective.
We do see the S&P 500 down about 4% at the moment, and has officially
what's the handle on that?
Entered a bear market. The S&P down 3.9%, 4,877.
Okay, so we are officially there. So 4,915 was pretty much that trigger. To cross over that 20% threshold.
Yeah.
This is the second fastest bear market in history, behind only COVID, right?
Yeah.
So we fall, kind of 10 or 15 days faster than kind of the 1987 bear market. Kind of in terms of the number of trading days from the start to a 20% drawdown.
Yeah.
So pretty historic.
Let me ask you this, Michael, because usually what we see during a recession, right, would be a 20 to 30% pullback in the market. You tell me, I mean, you're the expert here, right? So let's just say roughly, right? So we're down 20%. Is it realistic to think that there might be a bottom at 30% in this market? Or should investors and our viewers think of it differently?
Look, I mean, you're starting to price in, some pretty extreme scenarios, right? So, markets are starting to price in the idea that we are going to potentially have a recession. What makes this situation a little bit more tricky is just kind of the valuations that we had talked about, kind of coming into this situation, right? And so, there's a little bit more room, to see some of that pullback, right? If you kind of look at a year-over-year kind of flat earnings, right, that would be kind of around, $250 or so, kind of on the S&P 500, right? So you're starting to kind of get into those upper teens multiples, which is kind of getting you kind of back into more historical levels.
Michael Reinking, our resident expert based here at the New York Stock Exchange, is a senior market strategist for the NYSE. Michael, thank you.
Thanks for having me.